Welcome to TheoTrade. This is Don Kaufman. It's January 4th, 2019. Once again, Happy New Year. Welcome to the first week of 2019, in which we saw absolutely manic trade, which of course we're going to discuss to some degree in this weekend update. First and foremost, SPX is up to bat. Let's talk a little bit about the S&Ps, which in this shortened week, let's also kind of recall, December 31st, of course, was Monday. Markets were closed on Tuesday for the New Year holiday. So we were open Monday, Wednesday, Thursday, Friday. We had about an $84 expected move. And when I say this week was manic, yeah, I'm not kidding. However, we only finished on the week up about 46 points specifically on the SPX. So before you got that like bullish cap back on, back off for just a moment. Now think about what I just said. An absolutely manic week of trade where we were up huge, we reversed, we actually sold off really big on Thursday. We're like, oh no, we're going back into another down leg, only to see the markets absolutely explode back to the upside. Hopefully my description just there was as manic as was the marketplace. Anyway, the expected move for the entire week was $84. And it's a very, very key point to be made. In fact, on this week's update, specifically on Wednesday, I warned you of some wild and, again, kind of manic moves into Thursday and Friday of the week, and that's exactly what we saw. Sentiment is flipping and flopping, changing, okay, constantly. And that sentiment, I'm bullish, I'm bearish, and so bullish, bearish. Our sentiment here at TheoTrade, okay, remains completely and totally unwavered, and I'm actually going to explain a little bit more in depth, especially when we get to the charts. Now, as I said, the SPX was up first, and we had this $84 expected move this past week of trade. And what did we, again, actually do is about $46 of movement. So that's important. The implied marketplace, and the implied marketplace is what? It's options. The implied marketplace said $84. The actual movement was about $46. So with all of the events that went on, everything from Apple to now there's China trade talks to, of course, Jerome Powell. You gotta love that, by the way, today, Jerome Powell on stage with none other than Janet Yellen, Ben Bernanke. That had to be a party. Anyway, with all of that, we end up the week 46, which feels pretty negligible in comparison to some of the previous weeks. But again, the trade was rather manic. Now, with all of that insane trade, the next week of trade, we're looking at just over a $60 expected move. What gives? First of all, the $60 expected move, okay, is going to be during 5 trading days. So this past week only had 4 trading days. Now we have 5 trading days, and we only have a $60 expected move. So the expectations of movement are considerably less this next week. It's because, okay, today, this is Friday, January 4th, because today we rallied so substantially, we crushed down some of the implied volatility out there. Now, I'm going to leave it at that for just a moment. There's a lot to go over when I do show you the charts, but just recognize the big takeaway from that is all this kind of pent-up volatility aggression, the actual move this week wasn't that big, right? Wait, there's more. The move next week then contracts substantially. Doesn't exactly make me want to, salivate to sell some premiums specifically in the S&Ps. But I have a trade idea for you in just a moment. Now, the second point to be made over here, historical volatility. Now, some people are like, I don't know what that is. It's the annualized standard deviation of past stock price movement. That's a bit of a mouthful. The past stock price movement. Effectively, what I'm saying is the historical volatility, it's actual price movement. It's oscillation inside of, for example, in this example, the SPX. Historical volatility right now in the SPX, averaged on a daily over the last 20 days, is in excess of 30%. That is high, people. Okay? There's only one other period of time in the last 5 years that we've seen 30%, and that is, again, 30% historical volatility. But wait, there's more. You've actually got 40% historical volatility in the Qs right now. So the Nasdaq is absolutely rocking. So even though we saw this crush of implied volatility, again, you got to recognize this marketplace it really is manic. And we can denote that in volatility by looking not at implied volatility, but specifically historical volatility is telling us we're moving at a rate right now faster, harder, okay, more insane than at any other point. I mean, really, in the Nasdaq, you got to go all the way back down to the financial crisis to see this kind of movement. Or in 2011, there was a brief and fleeting moment that we moved at a rate of about 40% in terms of historical volatility in the Qs. Gotta love that. All right, a third point to be made over here, and the third point to be made, this one's a little bit out there, and I don't know exactly where to take you. I'm going to show you this in the charts in just a moment. The VVIX, the VIVIX, what is it? It's the volatility of the volatility index. Oh, it sounds so exciting. Well, really, okay, all it is doing is measuring, okay, the implied volatility of the VIX itself. And that thing is all the way down at 84. In all of this going on, and again, in this totally manic marketplace, I'm supposed to believe the volatility of the VIX itself is incredibly low. There's something to tag on to that, the skew. The skew is looking at the out-of-the-money puts in the SPX versus the out-of-the-money calls in the SPX. The skew, it's one of the lowest skews ever recorded. What gives? Okay, what that effectively means, and again, I'll show you this in just a moment. If you looked at the implied volatility of out-of-the-money puts versus the implied volatility of out-of-the-money calls, okay, it's actually one of the flatter skews ever recorded. What that kind of means is nobody's panicking to go out there and to buy puts, okay? Or specifically, they might be rushing in, okay, to effectively buy calls and kind of flatten out the skew. I don't look at this, either the VVIX or the skew, as being positive sentiment for the marketplace. As I said, our position here at TheoTrade hasn't changed at all. What do we effectively think? Okay, this wild ride to the upside that we've seen recently is one of the hallmarks or one of the most indicative signs of a very long-term hostile marketplace. It's just the sentiment just keeps flipping and flopping. I'm bullish, I'm bearish, the politics. You got everything out. Wipe it all away, okay? Clean the slate. And effectively, it's going to make you a much better trader. The last point, well, I'm going to show you here a trade in the QQQ. Why? Got a nice opportunity in the Qs. The Qs, okay, on a year-over-year basis, were down about 11%. They've now rallied from, on again, year-over-year basis, they were down 11%. Now they're down only about 2.5%, 3%. So they've rallied substantially, okay? You're looking at like an 8% rally in the Qs year over year. We're going to come in and we're going to sell an out-of-the-money call spread. But we're going to go far enough out of the money that the Qs would have to rally another 5 to 6% just to start to hit my break-even point. These are the kind of trades that I really like because statistically speaking, you've already had like this 8% rally. You know, you got to ask yourself, what's the probability of another 5 to 6% rally? Well, with that, let's get into it. Let's look at some trades. Let's look at the charts. To the charts we go. Let's get right to it inside of the SPX, and what you are looking at on your screen, these hash marks, well, they're effectively the expected move. This is the start of each week. This is the upside of the expected move, the downside of the expected move. Now, the expected move was equivalent to plus or minus $84, again, in this past week of trade. Said it was nothing, okay, less than a manic week. We rallied up, we sold off hard, we exploded back to the upside. Listen, net, we just ended up $46 in the week, as I said on the video portion of this. It was just like sentiment has completely flipped and flopped over time and again. And what I mean by like sentiment, it's, you know, a lot of people that were bearish, they're like, oh no, we are rallying back up, okay? Yeah, this is what you should expect. As I said, this is kind of one of those hallmarks, if you will, of a marketplace that is in very, very serious trouble. Let's put this thing into a greater perspective. I'm going to actually put this up as a default chart. And from October, okay, which we were trading very close to 29.50, we traded all the way down to 23.46. We bounced. What did you think was going to happen? Of course, there's going to be, you know, wicked bounces in the midst of this. Now, with some of these levels in the SPX in mind, and now I'm going to turn back on the effective expected moves, you got to realize there's been this big, again, kind of crush of implied volatility. As I said, this was an $84 expected move. Okay, coming into the next week, we only have a $60 expected move. Now, for me as a trader, like I'm not enthusiastic at this point to want to sell premium in the very, very short term because, well, you get a lot less juice, a lot less premium when there's a $60 expected move. And some people will actually quote the VIX. Sure, the VIX backed off quite a bit today, almost by a tune of almost 16%. But there's a lot more going on here than effectively meets the eye. One other thing I want to bring to everybody's attention before we go any further, okay, is to go into the S&P futures. And the reason I want to go into the S&P futures is because over time, we had to find some very specific levels, and we call these levels effectively gravity points, okay? Gravity points were these concentric areas of risk, okay, that are created by major trading firms. And effectively what you have in a gravity point, okay, is the market getting pulled literally to it. That's why we effectively call it a gravity point. We are not that far below, okay, once again, the 25.75. If you guys will remember back into the December timeframe when we were selling off hard, I mentioned, okay, time and again, that we wouldn't be surprised at all to see a bounce in the marketplace that would take us directly back to 25.75. So at this point in time, this is par for the volatility course. And I want to reiterate that this is par for the volatility course to see a bounce back to the upside. And that's why, our overall, tone of the marketplace, it hasn't changed. Okay. Yeah, some of the rhetoric out there, some of the sentiment has changed. It has said all the politics, you got to wipe it aside. Okay, because right now, this marketplace, this thing is in serious, serious trouble. So to come back up to 25.75 would not be a surprise whatsoever. Okay, before obviously seeing, again, what we're going to term as duration volatility. Now, another thing I want to point out is we're going to come back over to either the SPX or the spiders. Whatever does it for you. If you're comfortable pulling up the spiders, fantastic. If you're more comfortable pulling up the SPX, great. And kind of follow along over here because I'm going to knock this back to the default settings in the SPX. I'm going to bring up a study. I'm going to go add study down to volatility studies, and I'm going to cruise up to historical volatility. Historical volatility, once again, the annualized standard deviation of past stock price movement. This is historical volatility, okay, over 20 days. So it's averaged over 20 days. And as I was trying to kind of delineate a little bit earlier, you pull up like a 5-year historical volatility. We are up there, right? But to really, okay, behold, to really take a look at this in some greater detail, come out to a time frame even of 10 years. In fact, go out to a 10-year and knock it into a daily time frame, hit OK. If you take a look at historical volatility, which is right here, okay, which is actually north of 30%, it's alarming, of course, to say the least. All right, and back in this time frame, when you're looking back here, and you're like, what happened? What happened back here? There was actually in August, September of 2015, there was a major. Right here, a major kind of market collapse. There was actually one trading day back here in August of 2015 where the marketplace sold off over 7%. We actually went limit down. That's how wild. And again, in comparison, that's how wild we are right now. There was a day back here. Okay, again, in August of 2015, we went limit down. That's 7%. The cash open and everything locked up. That's how high volatility. And again, this is historical volatility happens to be. Prior to that, if you go back on a 10-year scale, you got to go all the way back into 2011. There's a brief and fleeting moment here in 2011. We thought we were going back into the financial crisis. Okay, and before that, again, you got to go back into the financial crisis itself to see kind of historical volatility like this. Okay, now the other point that I want to make, if you think historical volatility, actual movement in the SPX is kind of rampant, take a look at the Nasdaq. Okay, because the Nasdaq, in this case, I'll pull up the Qs. The Nasdaq is at 40%. 40%. It didn't even get that high, again, in 2015. We have to go back, as I said, into financial crisis kind of discussions to see this. And the reason I'm showing you the historical volatility, you're like, oh, that sounds really, really good. What's the takeaway from this? Like, everything I put together, I try to make sure there's a bigger picture, a bigger takeaway. Okay? The bigger takeaway from this is actual price movement inside of the marketplace, regardless of what any sentiment says, regardless of what's going on politically, okay, you need to know that actual price movement, you are in some serious crap right now, okay? And this thing ain't going away anytime soon. Like, you don't see actual price movement just collapse overnight. I don't know if it's going to continue to go higher. I don't think anybody does. Okay. But even the moves to the upside being this vicious, and you got to realize historical volatility is going up, with the marketplace going up. Okay. That should be worrisome to you because, again, it's one of the hallmarks of a much more bearish marketplace. And that's why I wanted to really bring it into kind of full scope today. Now, there's so much I could talk about in terms of price levels and everything in the marketplace, but there's only so much time. It's actually why on these kind of weekend videos, I kind of try to summarize everything for you. So historical volatility, again, point made. Next point that I actually want to make, all right? This is probably the most perplexing point to me is, and again, I don't necessarily have a big takeaway from this, but this is the VVIX, the volatility of the volatility index. And if you take a look at the volatility of the volatility index, it's all the way down here at 84, okay? Most of the time in the midst of extreme movement in the marketplace, right? When people are kind of freaking out and people are panicking, you typically see the VVIX up here, 110, 120, give or take, okay? Well, I went back and I started looking at a lot of the VVIX, okay? And again, here's a little bit more of, if you will, some manic movement inside of the marketplace. This is back in January and February of 2018. It was a long time ago. It was less than a year ago. But again, this is the kind of, manic moves that you should see inside of the VVIX during the midst of some heavy volatility. And you can go back in time, right, in any decent size move in the marketplace. By the way, here's coming back into, as I was talking about, that August of 2015. It's one of the highest readings ever inside of the VVIX. Even when it dropped off, okay, and the market cooled out, we were still at 100, 120, okay? We can't explain right now, and I've tried to explain it, other than we know that there are premium sellers in the VIX, and they're premium selling in a very big way. They're out there, okay, effectively selling calls, and the sale of calls is really suppressing, okay, a lot of the volatility inside of the VIX. But here's the thing that really kind of grabs me. If you look at the VIX itself, right? So here's the VIX, and this is just a 5-year on the VIX. So if you look at a 5-year on the VIX and you cruise over, once again, if you go to studies, go to add study, go to volatility studies, look at actual movement in the VIX, historical volatility, okay? Actual movement in the VIX. It's been bigger before, okay? This was the VIX at the most, again, one of the most extreme readings, ever, right? There was absolute turmoil in volatility. And right now, okay, right now, we're at 150, the 1.5, okay? The 1.5 is indicative, again, of 150%. 150% in terms of what? Actual price movement. Yet, if you look at the VVIX, which is the volatility of the volatility index, look back here like 30 some odd days out, it's like 80%. The two just don't jive. What effectively I'm saying is, okay, the VIX itself is moving way more, okay, than the implied volatility in the VIX is giving it credit for. The options in the VIX at this point shouldn't sell them. We should be a net buyer of options in the VIX, okay? Now, another point to be made on this front, skew. Now, skew, what is it, okay? For those of you that have never looked at skew is a calculation inside of the SPX. Now, the skew is only calculated once per day, and everybody gets all excited, like, I can't see anything. Show me something. I've actually got like a little skew line, okay? All I did is put a line chart together, okay? The lowest skew that's been recorded, and again, this is a chart right now that goes back since skew has been recorded. The lowest skew that's ever been recorded was right there, okay? You're like, well, what is that, okay? It happened to actually be all the way back, and again, this is in October of 2014. Now, interesting about October of 2014, this particular day, the marketplace was freaking out, and it was actually starting to rally back up. It was during the entire Ebola scare here in the United States. Anyway, the skew bottomed out before absolutely spiking back. What we can't explain right now is why the skew continues to go lower. Okay, there are traders selling it. Again, what it really in effect comes down to, I'm actually going to pull up the spiders because it's easier to see inside of the spiders. All right, we'll go about, some 30 days out. in effect, what I'm actually saying, okay, the out of the money puts, and let's open up a bunch of options in here. We'll open up 30 options, and we'll pull up what's called implied volatility. The implied volatility here in these puts, okay, versus the implied volatility here in the calls is not all that drastic. Again, the differential between the calls and the puts is not all that drastic. So in effect, what you could be getting, lots of people are out there selling puts. Could you construe that as bullish? Maybe. Okay. But at the exact same time, you could have people coming in and buying just loads and loads of calls. That could also kind of dampen down the skew. Either way, the skew has been looked at as a contrarian indication. This is not considered a bullish indication for the broader marketplace. And again, it is the second lowest skew ever recorded, within pennies, all right, of the lowest skew ever recorded. So where does that really leave us right now? Well, it leaves us with the notion that this is just a rally back, but these rally back, they can last quite a substantial time. One of the trade ideas, and I'll kind of finish off this weekend update with just a quick trade idea, because there's going to be a ton of trade ideas coming throughout the course of this week. But a lot of the different trade ideas are going to surround, okay, this same kind of concept. The Nasdaq. Let's go into the Nasdaq. Why do I like the Nasdaq? As I was saying about the Nasdaq a little while ago, is this kind of rally back in the Nasdaq. I'm going to show prices percentage, and I'm actually going to put this to a 1-year scale. Okay. The Nasdaq recently was right here. It was down, what, 10, 11%. It's now rallied up, but it's only down about 2.5%. So effectively speaking, the Nasdaq's already had what? Okay, about an 8% rally from absolute low to right now. Now, what I'm going to do is I'm going to sell some out of the money junk. Okay, what do I mean by selling out of the money junk? Well, again, given the fact that we've already had this rally, and again, it's been this 8% rally, I'm going to sell stuff up here. Okay, I'm going to sell out of the money calls. I'm going to sell out of the money calls, and I'm going to turn around and buy calls even further out of the money. Now, my trade isn't so much like by selling calls and buying calls. A lot of times this is construed as like a bearish bias. The trade to me isn't so much bearish as it is, okay, listen, we've already rallied what? 8%. For me to get tagged on these short calls, we'd have to rally up what? Here it is. We're down 2%. We'd have to be then up 3%. We'd have to rally another, okay, 5 to 6% just to actually crack through my break-even point. Is it possible? Yes. But the probability of that kind of a rally is greatly diminished. And that actually provides, if you will, a little bit of statistical edge outside of what we might think about implied volatility. How am I going to do it? I'm going 42 days out. I'm going to go 42 days out, and I'm actually going to sell, okay, the 165s and buy the 170s. And again, a trade like this, and I can show you in a moment some of the fills that I received on here. But a trade like this, it's $5 wide spread. A $5 wide spread right now is trading for about $1.19 credit. Earlier today, I was capable of filling this for better than $1.19 credit. I filled it for, okay, $1.27 credit. But let's kind of go off the numbers that are on the screen of the $1.19 credit. Now, of $1.19 credit, how much risk do I have? It's $5 wide spread. A $5 wide spread. Effectively, okay, you collect $1.20 up front. What do you have out of pocket risk? When you look at confirm and send, it'll tell you about $380. Ooh, I don't like that idea. What's the probability in the trade? Well, the probability in the trade, take about the 380, which is the credit, divided by the width of the spread, which is $5, equals, it's about a 76% probability. Okay, that's a 76% probability of making 1 penny or more. It's kind of the neat way to figure out the probability inside of a trade. Now, for those of you that don't want to figure out probability, what I call, that's like the old school way of figuring out probability. You could also just open up, like, what's the probability of this thing being out of the money? Look, it's 74%. I don't care which way you do it. Like, just get it done. That's the probability. So my little cheap and dirty method of 380 by $5 comes out to the exact same thing as a binomial regression model. Fun with numbers, people. But again, you got to come all the way back up to 165. Now, 165, as I kind of delineated here a moment ago, I'll take off the show prices percentage. Okay, 165 is rallying all the way back up to here. Okay, well, not only do we have to do this, we have to do this again. And I like those kind of positions. And you're going to see me, if we rally even more, you're going to actually see me layer Okay, a couple more call spreads out there. I want to produce a little bit of negative delta. Even though the volatility has collapsed a little bit, I kind of feel that this rally needs to be sold at this point in time. It's just how far are we going to go? As I mentioned a moment ago, it wouldn't surprise us at all, okay, to see us rally just shy of this, what we term that volatility box. And again, that volatility box comes up to 2575 inside of the S&Ps. With that, it's a lot to think about. Okay, if you do have good ideas about like, hey, why is the skew so low? Hey, why is the VVIX off so much? Hey, by all means, we're all ears. Because again, I've called around to every major trading firm, volatility arbitrage firm, and I know a lot of them. Nobody has a decent answer as to why the skew, okay, and that VVIX are that low. It's a lot to think about in this weekend's update. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.